could add is very complementary to what we just heard, because the first statement I'd like to make is coming from a report that the National Bank of Romania made in December last year, which said that 25% of companies in Romania could be described as what the term was coined zombie companies, zombie economics. And I think that's relevant, especially from this point of view, because it is normal and natural in situations of crisis, like we had in the pandemic and so on, to have blanket measures that help companies as a whole to move on, even if they don't have or don't keep a competitive edge at that moment. I think the big question now is what we do moving forward, because usually there is a tendency for these kind of measures, or the mentality that these kind of measures bring, to stay on for longer than we actually have the crisis in itself. So the fact that we accept at a certain point that it's more important for a company to keep working than actually generating profit shouldn't be something that we keep on for longer than necessary. If that happens, we will have a problem of competition, we will have a problem of the output that these companies can have, and as was said a lot yesterday, we aren't alone in this world, and we do have to compare to other economies who, in either way, are more oriented to performance than these are. So the general context that we see is this. We've also had a study made for the last 10 years looking at the impact companies, which we measure in Romania as being companies larger than €1 million. That's 5% of the number of companies in Romania and around 90% of the general GDP. So that's, let's say, the relevant economy. If you just look at this segment of around 32,000 companies, over 7,000 are, from a financial point of view, in some state of difficulty. Either we're talking about over debt, either we're talking about very small or lack of margins, positive margins, for more than a year, which indicates to us a lack of competitivity, and also indicates the fact that most of these companies, objectively speaking, as was said before, have a problem of attracting new capital. So you have a problem from the output point of view, and the National Bank's report said that that has a real impact on GDP of around 0.3%, so around 10 billion are just in these companies not being brought in because you don't have a positive output. And on the other hand, it stifles growth through credit in two ways. First of all, these companies have a very hard time of attracting new equity, because if we've got negative equity, it's hard to get new equity in. And secondly, they distort the market in itself, because if you keep in certain segments of the economy companies that don't have their own competitivity, it's hard for others who have larger costs in order to actually be able to produce positive margins to get access to credit, because they don't have a place in that market. So that would be the context that I think is generated by the natural measures that were taken and the normal and good measures that were taken in the last years, but we do need to think about what happens in the future. Now, from a policy point of view, we see a big difference, or a fundamental difference, between the way the ECB and the National Bank looked at this kind of bad debt or bad debtors 10 years ago versus now. When we were looking at this in 2013-14, which was the height, especially in, specifically in Romania, of restructuring measures and insolvency procedures, this came as a result of the fact that policy led to actually taking out that debt from bank balance sheets in order to protect the equilibrium in the banks. And we had a lot of debt restructuring, fast debt restructuring, on a big differences between what banks had to recuperate and what they actually wanted to. Now it's the other way around in some ways, because we have far better liquidity in banks, and that, of course, is a good thing, but that means that you have less pressures for banks to go after these loans. And it's another reason why we have a lot of companies staying in this situation of limbo, let's say, in which they don't actually get back to a positive area, but still are active in the economy. So the question poses, what are the answers and the measures that you can take? What we've seen in the last 5 years from the EU point of view is directives channeled at introducing in every European country measures that prevent insolvency, prevent bankruptcy, and actually pose a better framework for restructuring before the actual point of no return. We've seen those implemented in quite a good pace in most countries. We've got countries that have new policies they didn't have so far. We have a lot of countries even in Western Europe that adopted pre-packs and things like that they didn't have before. But on the other hand, from a professional point of view, I can say that on a Romanian level and on a European level as a whole, we are not seeing them implemented a lot. Because for now, general measures, policy, and the way banks are dealing with, let's say, questionable and not bad credit, to not be very blunt, has been more of a one-way street than something organized in measures meant to restructure. Even in this context, we believe that the more important issue that we need to think about is the actual health of these companies. Because independent on how we actually restructure debt, I think it's more important now than 10 years ago how we restructure operational costs and how we restructure companies themselves. Because the big issue that we see now is a lack of competitiveness in these companies and a very difficult struggle to get back to a positive side. Because we've seen a lot of increases in costs, both financial costs and also raw materials costs, that haven't always been pushed to the final product or to the final price of what these companies are selling. So what we see today is that if 10 years ago managing financial debt and managing a financial restructuring was enough to put a company back on track because you took away that heavy load and the margins of the companies themselves were net positive, now it's the other way around. Debt isn't that big, it exists, but on the other hand, even taking all that debt out, the output is still negative. So we need to address, both on a policy level, in my opinion, but also at an individual level, a much larger focus on performance of companies and actually incentivize that in any way we can in order to get back into, especially in Eastern Europe, where we are expecting growth at a higher level, to actually get back that level of competitivity, even if it hurts a little. And I would end by saying that I think this is a better time for it to hurt a little because we've seen all these episodes in the last years. And if we don't do it now, it's going to be harder to do it when the next difficult event comes.
Okay, thanks very much, Paul.